We're joined on INSEAD Knowledge by Cyrus Mewawalla. You're an analyst. You worked in investment banking for many years, corporate banking, then switched to become an analyst, and you've got your own research fund now.
That's right.
You're also a novelist under the nom de plume Cyrus Moore, City of Thieves. And we're joined as well by Craig Smith, an INSEAD professor. We're going to be talking about ethics and banking. You've just been speaking here to the students in Singapore about this issue. From what you're saying, it seems as though nearly all bankers are evil.
I don't think I'm saying that, Stuart. I'm saying that over the last 10 to 20 years, two big catalysts have changed the structure of banking in the Anglo-Saxon world. The first is the repeal of the Glass-Steagall Act in 1999, and earlier to that was Big Bang in 1986. And those two changes effectively deregulated both sides of the Atlantic. And as a result of that deregulation, bankers were allowed to do things that they weren't allowed to do before. And some of those things, having been not regulated well, have led to this last crisis.
You spoke about greed and deception.
Yes.
Are those the two main characteristics of bankers today?
Bankers aren't greedy or necessarily deceptive. The problem is banking has become so complicated that no one human brain can comprehend all of these products. And we've had a number of crises, from the local authority crisis in the UK 5 years ago to the Greek crisis currently, that are all related to the clients of investment banks not understanding properly the products that they are buying, and the bankers, on the other hand, not explaining properly the products that they are selling. And then when those products explode, the bankers are saying, well, you should have understood it, my client.
And what about the conflict of interest angle? That, in essence, who are the banks representing? Are they just representing themselves?
The bigger an organisation gets, obviously the higher the scope for conflicts of interest. I spent 10 years of my life at PwC as an accountant. You know, there were loads of conflicts. The first conflict is, as an auditor, there were loads of conflicts. First conflict is you're auditing a company. You're being paid by the company that you're auditing. So clearly there's a conflict. Perhaps you should be paid by somebody else. Perhaps a fund should be set up by the government, paid. Where your client pays into that fund and then the fund pays you, so it's independent. So all big organizations have conflicts, and that's partly why many industry commentators in the banking sector are calling for banks to be split, because that's a crude way of avoiding some of these conflicts. Now, you'll never avoid all the conflicts, but you certainly will have less conflicts if, for example, if you look at my own field, independent research or equity research within a bank. There's no reason for a bank to do equity research. The reason they do it is for economies of scale and to leverage, to use the banking word, to leverage an analyst's capability when they sell a deal.
Craig, do you have anything to add at this stage?
I'm very curious about why the market fails us in the banking scenario. Why is it that seemingly banks can act in ways that take advantage of clients, that don't put the clients first, and yet not be penalized by the market? Why is it that their reputation isn't harmed? Why is it that the clients seemingly just keep coming back to them despite being taken advantage of? And I'd be very curious to hear Cyrus's thoughts on that.
Well, banking is essentially an oligopoly, and during this last crisis in the UK, it became more of an oligopoly because two of the big banks went under, and the government actually actively helped a third bank merge with one of them. So if you want to merge with if you're a large company interested in M&A, if you're a large company interested in raising debt or structured debt of any type, if you're a large company interested in expanding abroad and raising debt in various currencies, maybe Chinese currencies which are coming up, then you need to go to a big investment bank, and there aren't many of them around.
You spoke about Basel III in the session. You also spoke about an insurance fund and policy. How would that work?
I think there's a lot of bank bashing at the moment by politicians, spurred on by voters, that's really not helpful. And a lot of emotion in the argument, and the emotion usually channels itself into, oh, let's tax bankers, let's tax banks or let's tax bankers. But actually I think that's an unhelpful way to look at the situation, because banks benefit the economy and we need them. So we need to incentivize them and motivate them. And we shouldn't talk the language of voters, we should talk the language of business when we deal with banks. And the language of business, if the two parties are the UK taxpayer and the bank, is that if the bank wants the UK taxpayer to bail it out in the next crisis, then let's set up an insurance fund to fund that bailout. And let's segment the banks into different kinds of risk, and let's charge a risk premium to each of those segments based on the risks they pose to the economy. And some of those segments, so if you go back to my continuum, you've got the traditional retail bank here, takes deposits and lends out, and you've got the hedge fund here, let's say, which might have demerged from a big bank. That bit needs to be bailed out by the taxpayer, that bit doesn't. That bit's more high risk. So you price the risk accordingly, and then from the economy's point of view, from the taxpayer's point of view, I see no problem with the risky bits of banking moving abroad, because in the long term, it may not be worth having those risks in the country.
It wouldn't be possible to ring-fence them sufficiently that you essentially minimise or mitigate that risk to the bank?
It depends what kind of risk you want in your economy. So in general, the Anglo-Saxon world has taken the view that they want to be the innovators in banking. When you innovate in banking, you invent new products that at first regulators can't understand. And if you take that view that you want that innovation in your country, then you're taking the view that you want a high-risk, high-reward banking culture. If you go to India, where they don't have many innovative banking products because the RBI doesn't allow them to, then you have a different kind of structure. And we can both see which structure benefited in this crisis. Although before the crisis, obviously, the Indian banking sector wasn't doing as well as the Western one.
What would you say is the current state of banking in the UK? From what you've seen, has it improved at all following the crisis?
I think the state of banking in the UK is in utter confusion because nobody knows how the banks are going to react. Some have threatened to leave the UK. Some are demerging units, hiving off units into private companies. Some are losing teams of staff, highly rated staff. And nobody knows, and that's primarily because nobody knows how the government is going to react. Nobody knows if the 50% income tax is going to stay. Nobody knows if the super levy on bankers' bonuses on banks is going to come back. Nobody knows how banks are going to be regulated, and nobody even knows how the Basel III new rules are going to be implemented.
You spoke about the bonus culture. So, Craig, any last thoughts?
I just think it's a fascinating topic that we're not going to see the end of. I think it's jury's still out on whether adequate regulatory responses are going to be forthcoming. Jury's still out in terms of whether we're going to see adequate governance with respect to the banks, whether shareholders are really going to be keeping a closer eye on their investments, and indeed whether bankers will rise to the challenge of managing those very real conflicts of interest, those very real temptations that they face in their day-to-day lives.
So given the uncertainty, it doesn't seem as though there's much scope for optimism, really.
I think there's a lot of scope for optimism. I think countries need banks and banks need countries. And I think governments are, on the whole, going down the right track. I think the Basel III new rules are following the right track. I think implementation is going to be tricky. The definition of core capital has been redefined. It's still tricky to actually know what it means. But let's see. But I hope that governments set up some kind of insurance fund to help us in the next crisis, so that when the next crisis comes, we've put aside the money to deal with it.
Cyrus Mewawalla and Craig Smith, thanks for joining us.
Thank you.